Well, good morning, everyone. Welcome to Getting Started with Options. My name is Barbara Armstrong. I'm a coach with Schwab. Delighted that so many of you are here to bring this class to life and join us live. Today, we are going to talk about a bullish strategy called a long call vertical. This is a strategy that frustrated me to no end when I first learned it because I had high expectations for it. And I've learned to love this strategy over the years. And there's a little bit of something lovable in every strategy that we talk about. If you are joining us for the very first time, please feel free to type a greeting into the chat. So that we can welcome you. We link arms here every Tuesday at high noon Eastern. And over a 12-week period, we introduce 10 different trading strategies. So 10. And there are some strategies that are designed to work well when the market's going up. This is one of them. There are strategies that are designed to work well when the market's going sideways. And there are strategies that are designed to work well when the market is falling. And all of these strategies can work beautifully in different directions, but all of these strategies also have risks. And with the type of strategy we're talking about today, how much could we lose? We could lose every penny we spent to open the trade. So it's really important that we understand not only the potential benefits of a strategy, but the risks involved as well. And we're going to discuss both of those. If you're joining us, like I said, for the first time, I'm not assuming that you know anything about calls or about the long call vertical strategy in particular, so know that you're in exactly the right place. I always like to start by welcoming everyone that is with us. So hi to, BJ and Sandeep and William and Ray and David and Janet and Kevin and the rest of the gang. It's great to have you all here. One of the benefits of being here live is that you get to just more actively participate in the community. So if you're watching this in the archives and you have a chance on a Tuesday at noon Eastern to join us, I encourage you to do that. We have Cameron May with us in the chat. He's a friend and a fellow coach. I've learned a ton from Cameron, and one thing I know is that he knows this strategy inside and out. So if you have any questions, please don't hesitate to ask. Okay, also consider this an invitation on behalf of both Cameron and myself to follow us in the land of X. Cameron's handle, Cameron May CS, my handle, Barbara Armstrong CS for Charles Schwab. Know, though, that no coach will ever reach out to you, offer, if you give them access to your accounts, to trade it on your behalf and split the profits. I've seen that. There's a lot of scammers out there. We'll never offer you a Bitcoin or a crypto deal or education for a fee. So just be aware that if somebody reaches out to you, it isn't the real Barb Armstrong or the real Cameron May. And take a screenshot and forward that to me, and we'll make sure we get those ne'er-do-wells shut down. Okay, so know that options carry a high level of risk and aren't suitable for all investors. You have to apply for option trading privileges with Schwab, and not all will qualify. We want to take transaction costs into account. And like I said, when we do a long option and we're paying to get into the trade, we could lose the entire amount that we invested. We use the Paper Money software application, the desktop version, and it's a brilliant place to learn and make sure you understand your trading plan and what you're trying to accomplish, that you understand the trading strategy, that you understand how to place a trade on the platform, how to get out of a trade that you've placed on the platform without risking, real money. Okay. Now, there are some nuances and differences. The biggest one with the strategy we're looking at today is that we don't get to practice a short option being assigned early. Now, if I just spoke in Greek there, don't worry about it. I will explain that. But short options will never be assigned early in Paper Money, and that can happen in a live account. Okay. And so we're going to talk about what to do if that happens. So on today's menu, we're talking long call verticals, what that strategy is, and why an investor might choose to use that strategy. Then we're going to go over some of the basics of what long call verticals are, what some of the benefits and risks are. We're going to look at an example trading plan that includes when you'd get in, how much you'd consider buying, when you'd get out, and we're going to place a couple of example trades and then look at how we'd manage those going forward. Now, this is not a mistake. I put a blank page in here because for the visual learners in the crowd, I think this is a way to kind of frame what you're looking for. And this is my drawing tool. I don't know why it showed up there. So let me, okay, showing up here again. And I don't, here we go. Now I can move it over. All right. Just one sec. I just lost my chat. I wanted to make sure I brought that back up. Okay, so let's pretend we have this stock, and this is representing a stock that's been going up. Maybe it pulls back for a few days, and then it starts to go up again. Maybe it pulls back for a couple of days. And when it starts to go up again, we say, hey, we see a trend. This is a stock that's uptrending. And I am going to look into my kit bag for a strategy that can work when a stock is uptrending. I'm going to say, you know what? Barb talked about that long call vertical strategy. What I'm going to do is buy a call right here. And in fact, what we often do in our examples, when we buy the call, is we'll buy the call below where it's currently trading. So let's say, you know, it's trading at currently $51. Or, you know, we can do this with a more expensive stock. So let's say the stock is trading at $500. And so we're going to buy a call at, well, actually, let's say it's at 502. So we're going to buy this 500 call. Now, this call might be pretty expensive. It's a $500 stock. So let's say that costs $15. Well, $15 a share, and it's times 100 shares, that would cost us $1,500. And when we buy a call, what does it even mean? Well, when we buy a call, what it does is it gives us the right to buy 100 shares of stock at $500. Well, you know, I teach a trading a small account class. And, you know, we have about 34,000 in that account. And so what you're telling me then is if I have an account with only $34,000 in it, I can't even buy a call. Like, what would be the point? You know, because I can't afford to buy 100 shares. That would be $50,000. But our intention when we do a long call vertical isn't actually to buy the stock. We're expecting the stock to continue to go up. So what we're going to do is we're going to sell a call, which means we're agreeing to sell the stock at maybe 505. And when I sell a call, what does that mean? Well, what I'm doing is obligating myself. I'm saying, hey, if you would like to come and buy this stock from me at $505 a share at any time between now and when this call expires, I would be happy to sell it to you. You're going, well, just a second. I don't own 100 shares of stock. How could I sell 100 shares at 505? I don't even have them. Well, our intention isn't to actually buy and sell the shares. Our intention is to just benefit from the sale of this option. And so let's say I've bought this and I paid $15 for it, and then I sold a call, and maybe I sold the call I sold for $13. So then how much have I invested? So that's 1,300 because it's times 100. So the net is that I'm risking $200. And if this goes up as I'm expecting it to, and it goes through both strikes and stays above both strikes, then we're happy campers. And how much can we make on this? Well, what we can make is the difference between the strikes, the 505 minus the 500. So our max gain on this would be the difference between the strikes, the $5, minus what we paid to get into the trade, which is $3 a share. And what's our max risk? Well, our max risk is what we paid to get into the trade. So that's $2. So our potential return on risk would be $3 we can make, and we're risking 2. So mathematical genius I am not, but that looks like 150%, like $2 would be 100%. Now, often what some people will target, what some traders might target is maybe a 2/2, like 100% gain. Now, what we found and what I personally found when I started trading this strategy, and let's say I was risking 250 to maybe make 250, I wanted to get every scrumpy bit of that 250. And you know how often I got it? Almost never. And so when I started teaching the trading a smaller account class, and we created an example trading plan, we created a goal, and our goal was a 50% return. So, and you can make your goal whatever you want. It's your trading plan. And so if we are getting into this example trade and we're risking $2, then our goal would be to get out at $3 and to make $1. And so our goal would be to exit at 3. And that would give us a 50% return. And what we have found is that if we are correct and this keeps going up, that the odds of us reaching this return faster are higher than if we're holding out to try and get a bigger return than that. And then we have the opportunity to maybe place another trade. We call that wash, rinse, repeat. So are there any questions on this? Is this a brand new strategy for many of you? Somebody has typed a comment into the chat, and what they've said is, with options, it's difficult to work out when to enter and when to exit to maximize your gain and mitigate your losses. So I really like that you mentioned losses also. So our second goal is that if the trade is not going according to plan, even though we're position sizing for 100% loss, that if we have a 50% loss, we're going to cut our losses and exit. And so we know before we get into the trade when we're going to exit. Okay? So does this make sense? I hope so. Okay, we're going to wipe that slate clean. And this is being archived. So if you want, you can always go back and watch it again. So just kind of, again, as an overview, how do we create that long call vertical? Well, we create that vertical by, let me erase that. First, we're going to buy the more expensive call, and then we're going to sell a call above it that is less expensive, and that results in a net debit. But what that allows us to do by selling the less expensive call above it is that it gives us the ability to potentially trade a stock that we might not be able to afford to trade otherwise if we have a max risk guideline in place. And in our trading a smaller account class, that is about $500. We don't want to risk more than $500 to $550 on any one trade. So a call option gives the owner the right when we buy, at the underlying strike price, it gives us the right to buy the stock at that strike. Now, when we sell a call, we are obligating ourselves to sell the stock. And in this case, it's selling stock that we don't own. So bullish. So we're going to talk about what happens if we're called out and how we react to that. Because that was a question I had when I first got started with all of this. Okay. So what's the benefit? Well, we can benefit, with a relatively small investment from our speculation or our expectation. I think I like the word expectation better, but that a stock is going to continue to move in an upwards direction. And it allows us to participate in higher price stocks that might be out of our snack bracket otherwise. Okay. And our gains, now we're putting a cap on our gains because it's limited to the difference between the two strike prices minus the debit paid. And we've already gone over that. And this tends to be a shorter or more intermediate term trade. Typically, we're looking maybe out 20 to 50 days. And we're looking at a strike price that might be slightly in the money. Our strikes, we call that ITM is in the money, to sometimes at the money, so very close to where it's currently trading to maybe a strike out of the money. Now, the more bullish you are, if you're really bullish and expecting the stock to really move, you might, look more for an out of the money strike, and we'll get to that. So what are we risking? We're risking the debit that we paid to get in, what we paid to get in, and how much of that could we lose? We could lose all of it. Have I ever seen that happen? Yes, I have. And this is why it's important for us to define how much risk we're going to take and then to manage that risk once we're in the trade. And so, with a long call vertical, we do have a short option. And although we don't get to practice that in paper money, it can be assigned at any time, regardless of how far it is in the money. Okay. And, the more contracts we buy, the more risk we're taking. And then we want to take transaction fees into account. At Schwab, that's 65 cents per leg per contract. Okay. And, we could also end up owning the stock. Long stock means you own it. And how can that happen? Well, if it ends up in between the strikes at expiration and the call that we bought is in the money, then it would be assigned. And if the short strike is not in the money, then it would expire worthless. And then if that happened and we're looking at Meta, we could expect a knock on our door saying like, hello, you do not have 50,000 in your account and you just bought 50,000 worth of stock. Are you going to put more money in? What are we doing here? So you don't want to get that call, do we? We do not. Okay. So I'm a big fan of having a plan. If I'm making something I've never made before, I'm going to find a recipe. And so, we have created actually a recipe for long call verticals. And if you want to see that, I put it in the trade management mini sessions. And so if you come out here, and everybody's going to want to subscribe to this regardless. So there's a button down in the bottom right corner. You'll want to hit that. And when you come to this Trader Talks from Schwab Coaching, you'll want to come down to playlists. And when you come to playlists, if you want to watch this session again, you would come down to the bottom. And we're in the second to last row, view full playlist. And then you'll see, here was the first one, the basics, and it goes through that 12-week rotation. There's also, if we come back out here, a section for these mini sessions. And if you're newer to Thinkorswim, all of these kind of turquoise are quick 10-minute things on, setting up a chart or a watch list, customizing a watch list, that kind of thing. Cameron May also teaches a great class on Mondays, getting started with Thinkorswim. If you're new to that, you may want to check that out. But here is our example trading plan, and there's a 17-minute webcast that kind of outlines an example trading plan that you can then use to customize and make your own trading plan. just so you know where that is. But coming back to our PowerPoint here, this is the first section, and there's always four key sections. It's what to buy, how, when to buy, how much to buy, and when to sell, when to exit. And so this is part of our what to buy. And, so we're looking for a stock that is in a bullish trend. And some might also, and I used to create a checklist for every strategy I traded. I wanted the stock to be uptrending, and then I'd look at the sector. Was the sector uptrending? And also, was the market uptrending? And right now, the market is close to all-time highs. If it's not hitting an all-time high today, and depending on which sector we're looking at, that may or may not be uptrending. But we're looking for a stock in a bullish trend, and this is kind of the icing on the cake. If the market is tanking, you might not be looking at the strategy at all. Then we're looking for stocks that have higher trading volumes, and you're going, hello, this is an options class. But if the stock has high trading volumes, and you might say, well, I want that to be 1 million shares a day or more. I've seen James Boyd do queries where, he wanted it to be 5 million. I mean, you can make it whatever you want. But if you have a stock that's heavily traded, chances are the options are going to be more heavily traded. And that's expressed as open interest, which is the number of contracts that were on the books when the market opened, and volume, which is the number of contracts that have traded today. So as a rule of thumb, you might say, well, I want that to be at least 20 times the number of contracts I'm thinking of trading. Now, others might say, I don't even have these columns on my option chain. I don't really care. As long as the bid-ask spread is tight, I'm going to assume that I've got lots of trading volume. And you know what they say about assuming, but I mean, you can make this whatever you want. It's your plan. But you might say, well, I want the bid-ask spread to be less than 10%. And the difference between the bid and the ask price, that's what the market maker makes for matching up the buyers and the sellers of the options. And if he's, that you're looking at a stock like Apple or, another stock that is very heavily traded, then often those bid-ask spreads will be pennies apart. Because they're doing so many of them, it's really easy to find buyers to match up with the sellers. If there's not much trading volume, the market maker may, and in fact, end up being the one to take the other side of the trade, and he's going to want more money. He or she is going to want more money if they're doing that. Okay, so that's an example there. Now, so that's one of the 4 pieces. The second one would be when to buy. And so we're looking for entry signals that are bullish. And there are a lot of different entry signals. I mean, here are a couple of the basics. And again, Cameron May also teaches a class called Getting Started with Technical Analysis, and that's coming up later today. So you may want to tap into that. But we want stocks in a bullish trend. So we want something that's uptrending. And so you may consider getting in when something is bouncing off support, or, if we have that flag pattern. Here's our flag pole, here's our flag, and then it continues to go up. So, and maybe it's bouncing off a 30-day moving average or a 10-day moving average or a 50-day moving average, whatever it is. And we're looking for, on the candles, it to be uptrending and to see a close above the high of the low day. And so, if we've seen something coming down, or if we're seeing something breaking out of resistance. So here was something that kind of in a bit of a sideways trend, and then it broke out. And so, you might look at placing a trade. Some might place a trade on this day. Some might place it on this day, and some might wait, for the 3rd day. But, we're looking for a stock price that is closing above the high of the low day. Okay. So let's go out and look at the charts, because I think that it's in looking at the charts that, it kind of takes this theoretical concepts and kind of brings it to life. So if we're looking at AMAT, so AMAT is a tech stock. It is Applied Materials. If you're not sure of what category a stock fits into, if you hit the Analyze tab and you come down here, you'll see the sector it belongs to. So that is AMAT. Is it uptrending? Well, it's up 47% almost year to date. It was uptrending, kind of consolidated for a bit, and then came up. And could this be seen as a bit of a bull flag pattern? You know, where it came up. Let me just get my drawing tool again. Came up, pulled back for a few days, came up, pulled back for a few days. Do we have a close above the high of the low day? You know, that probably happened. Actually, I'd say we're looking at that. If this was our day here, let me see, we probably have that now. So if this was our low day and that high was 235.41, are we above that? We are. And we've seen we have a recent high here of 249. So if it's at 237, could we perhaps come out and buy the 235? So we're kind of straddling the current price of the stock. Could we come out here and maybe buy the 235 and then maybe sell the 240? You know, we could look and see if that is is a choice. Now, sometimes with more expensive stocks, the bid-ask spreads might be $10 wide. And we'd have to look at that. The other thing, if we were saying we want a stock that's uptrending and a sector that's uptrending, if we wanted to look at the sector, and we said, okay, here's our tech sector. It's up 11% year to date. But, you know, when we look at the last year, so if we come here and we change this to show price as a percentage, and then we look at the tech sector over the last year, it's up 23%. So it had a bit of a pullback here in April, but overall it's now uptrending, right? And we had a little bit of a pullback and it's moving again to the upside. And how about the, market in general? Well, the S&P 500 on Friday hit a new all-time high. How about the NASDAQ? That's a pretty tech-heavy index. Is that uptrending? Well, it's up 30% in the last 12 months. So one might argue that that's uptrending too. So check, check, check. Okay, so if we come to the trade tab and we come back to AMAT and we say, okay, it's sitting at 240. If we come out in that 20 to 50 days, and one other thing I want to point out on the charts is we have this little blue dot here. So August 15th, we have earnings. And so if we look at it and we said, well, I wouldn't mind going to a monthly option. Well, earnings is the day before. So if you don't want to, maybe one of your rules is, and in our example trading plan, we said, we want to trade this more conservatively, and sometimes stocks will gap up or down on earnings, and we'd rather not go through that emotional roller coaster and perhaps take a trade that had been profitable and turn it into a losing trade if it gaps against us, gaps down. So we're not going to go for this monthly. And what's the advantage? We have lots of volume here. And here we have a 20-cent bid-ask spread. So if we're looking for a tight bid-ask spread, it trades more than 1 million shares a day, check. How about if we came out to August 2nd? So we're looking at 30 days on the weeklies, and we can see this is in purple, and it says weekly. So here, if I take a look at the 235 and the 240, do I have at least 20 times the number of contracts I want to trade? Well, 22, 29, and 138, is the number of contracts that were on the book. So yes, and these $5 wides probably just recently opened. So if we look at, do I have a tight bid-ask spread? Yes, it's an $11 option, and I have a 35-cent bid-ask spread. So, or 25-cent bid-ask spread. It could be a $1.10, and I'd still be okay. And so when we look at that and we say, okay, does it meet those requirements of trades more than 1 million shares a day? Check. 20 times the number of contracts I'm looking at trading? Check. Tight bid-ask spread? Check. 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 Okay. Okay, so now we're going to see how much do we have to pay for this. And if we're in our smaller account and we can't risk more than $500 to $550, you know, to just buy the call really is out of our snack bracket. So we're looking at buying the vertical. So it's 235 and 240. And if we come and we look at the probabilities on this, I've added a column that says probability of it being in the money. So the probability of it being above 240 come August 2nd, 31 days from now, is 46%. And you've got a 92.9% chance that it's going to come up and at least kiss it. Okay. So, Frankie, ideally, we're looking for lower volatility. And that just depends on the stock, how, you know, low volatility for one stock might be high volatility for another. You know, and with AMAT, this is the volatility currently is at 33.6%, but the volatility in the market overall is low. Right now, which makes it less expensive to buy. So we want volatility to be low when we buy and go up. And as this approaches earnings, you know, volatility might go up. So how much are we risking here? $258. How much could we make? Well, the difference between the strikes, $5 minus 258 or 242. If you don't want to do the math, if you bring up our trade page, so our max loss $258, max profit 242. Okay. And if we're willing to risk just over $500, we could say, well, we could do 2 of these. And then what we might do is say, you know, I like to golf in the summer. Actually, I'm not a golfer, but a lot of people are. So I'm going to take this 255 and multiply it by 1.5, and I'm going to put in an exit so that if I'm, you know, out walking the dog or playing golf or on a dock somewhere or on a boat, you know I'm in, you know, this trade might end up filling and I could be out of the trade. So we're going to make this 380. When it gets to 380, we'd like to exit. Now, why am I not doing an OCO order? Because the other thing is if it goes down to $1.25, I also want to exit. And the reason we're not doing that is sometimes when the market opens, there can be a lot of volatility and we could end up out of the trade at way greater than a 50% loss. And, you know, then the market settles down and we wouldn't have been out at all. Now, if we end up nicked out for a 50% profit, we're okay with that. We'll fall on that grenade, you know, 6 days a week, you know, but we're willing to take that risk, but we don't want to risk getting stopped out and then having the market settle down and we're out for a bigger loss than we were anticipating. But we're position sizing based on max loss. So how much could we lose? 516. This is our theoretical max loss. And how much could we make? 484. But we're saying, hey, if we can make about 250, we'd be happy campers. Okay, we're going to put that in our long call vertical group. And then this is saying, note that you've selected a weekly option. Yeah, we're okay with that. Okay. Somebody's asking what strategy would be easiest to learn for a newbie to grow a small account. You know, I teach a trading a smaller account class, and we do a lot of that when the market's bullish, long call verticals and short put verticals in that class because we're we're defining how much profit we can make, but we're also managing how much we could lose. But you know what? The whole purpose of this class is to go through this rotation of 10 different strategies so you can decide what's most appropriate for you. Yeah, like Cameron said, the long call strategy is probably the easiest one to learn, but it limits us if we're not willing, if there's a parameters on how much we can risk. Okay. So we now have that trade on. Now, how do we monitor it? So we've talked about what to buy, when to buy, how much to buy, when do we exit? And so our plan might say, well, we're going to exit when we're either up 50% or down 50%, or if it breaks a major support level and looks like the trend is changing, we might choose to exit before we've lost 50%. Or what if the stock goes up and then we get a candle pattern or something that indicates that it might be starting to come back down? Maybe we're up 40% and we'll say, you know what, 40% is close enough. So if I look at this is Apple. We placed this trade a week or so ago and we said, okay, this is, let's say instead of 17%, it said, hey, we're up 44%, but today's number is negative. That might be saying you should go out and look at the chart for that trade. Now today's, isn't negative. And here are our strikes. The 215, we have a long call vertical at 215 and 220. So here's the 220 strike. Well, what if we're not paying attention and this expires, let's say it expires, I usually put the date on it. It expires July 19th. But let's say we're on a riverboat cruise in Europe or something, we're not paying attention. And let's say this was our expiration date, and here's our 215 strike. If this were the expiration date and it expired at 219 and this was the expiration date and we hadn't closed out the trade, the 215 strike is in the money. So now we're the proud owners of $21,500 worth of Apple stock. And we don't actually have, we don't have $21,000 worth of stock available, worth of cash available to buy it. So that's when, you might get a call from your broker saying, could you put more money in this account, or you're going to have to liquidate something to pay for this stock that you bought. So how do we avoid that happening? Well, we avoid that happening by closing out the position prior to expiration, because the strike that we bought is not going to be called out early. Now, what if, let's just play the what if game. So what if the stock has gone up? It's continued to go up. And let's say, here's our strike at 220. Let's say it's gone up to like 240. And could that happen? Sure. Did you see Tesla today? It went up like 8%. And here is the strike that we sold. And so we're willing to sell the stock at 220. And let's say this is the expiration date, July 19th. So we still have a couple of weeks to go and we get called out. Could that happen? Yes, it could. So we get called out. We now have to sell. And if we have 2 contracts, we have to sell 200 shares of stock that we don't own. So what do? Well, we immediately go in and we could exercise our right to buy at 215. So we come down and we say, okay, here we go. I'm buying this stock to meet the requirement to sell it. And so you've both bought and sold within the same day if it's exercised, and you're now out of the trade. So how did that work out? Well, what happened is you now got your max gain, which you weren't even going for. You were going for a 50% gain. So you ended up with your max gain, which was the difference between the strikes less what you paid to get in, And so there is joy in the land, dancing in the streets, and then you can go in and use that money to place another trade. Yeah, so Luis is asking, can I talk about how options increase or decrease in value? And, we now have to wrap things up, but it's based on how much time is left till expiration. Volatility can have an impact. So when volatility goes up, it tends to pump the value of the options up. But because we both bought and sold, that has kind of a more muted impact. And then the price of the stock. And the price of the stock of the underlying is, can often have the biggest impact. Okay. But for that, we'd have a conversation on the Greeks, and I may do a little mini session on the Greeks. But if you go to our page, you'll see there's a search bar. And so if you go to YouTube, and you've hit that subscribe button, you could type in option Greeks, and I'm sure you'll find several classes that talk about that. Okay, so those things all can impact the price. But as we get closer and closer to expiration, if it has gone through both strikes, the value of this contract is likely to be going up. Yeah, delta, it tells us how much a stock, an option will go up in value when the stock goes up by $1. Okay, that's what it tells us. So if you wanted to go out and do some additional practicing, often what I'll do is I'll bring up the NASDAQ 100, which is a public watch list. And so, like today, we already have a trade, a long call vertical on, but could you place a trade today? Do we have a close above the high of the low day? Yeah, that happened at the end of day yesterday. Could we look at today being sponsored by the letter A, American Express? So, is that uptrending? Yeah, up 25% year to date. And, it's been uptrending, pulled back, and then, crossed the 30-day moving average, had a little pullback here. You want to be aware of when earnings is coming, but might that be a possibility to get off of A and go over to Meta? Has that stock been uptrending, up 43% year to date? And came up and kind of consolidated, got hit on earnings, and then has kind of worked its way back. And again, moving, again to the upside. So if you wanted to do some additional practices in your paper money, these are just a few stocks that you might consider using for practice. Okay, so let's go back. And we've talked about what can happen. If it goes through both strikes, if it goes through, just one strike and closes in between. And these are things we need to be aware of. And so part of your example trading plan might be, no matter what, I'm exiting this trade prior to expiration. Yeah, so we can see this as a recording. And if you go back to the archive on this, Arif, I did show how to go to that subscriber channel. If you subscribe to the channel on YouTube, Trader Talks from Schwab Coaching, just look for Getting Started with Options. And there will be a link in at the end of this webcast. And then you can watch this as many times as you like. So we've covered long call verticals, some things to consider, some of the metrics we want to look at. We've looked at the risk. We could lose 100%. We've looked at some of the basics. When to get in, when to get out, what can happen prior to expiration. And we've placed an example trade. And then we've looked at, how much time it takes to manage it. And for today, we looked at it and went, hey, we're good to go on both. We're not close to 50% up or down. And so we're done. So know that the example we looked at today was for example purposes only. So here's my ask of you. If you haven't had a chance to do a favor for a random stranger yet today, if you hit the like button, you could be doing just that. It lets Cameron and I know you found the content valuable, but it also moves this up in the YouTube algorithm so more people can find this content. So you could be doing a favor for somebody who's looking to learn how to trade a strategy like this. So hit the like button, subscribe to the channel. Don't forget to follow us in the Land of X, Cameron May CS and Barb Armstrong CS. And that's a wrap. One last thing, we've talked about exiting prior to expiration, or when you hit a target profit level or a target loss level, or if it's breaking a support level. But know that next week we're going to talk about the bearish companion strategy to this, which is debit spreads. So you'll want to come back for that. And then we're into protective puts, and then the things I wish I'd known when I started. If you have some time over the long weekend and you want to do some binge learning, you can come and, watch the entire series. But the goal is by the end of that 12 weeks for you to have an idea of the strategies you might want to look at mastering first. So if I don't see you tomorrow, please enjoy the 4th. Have a fabulous long weekend, and I will look forward to seeing you in a webcast coming up soon. Up next, Trading Breakouts. Take care, everyone. Bye for now.